let's talk a little bit about the mechanics of investment vehicles by talking about assets and then the liabilities and then the equity. So the assets. And the assets are going to be listed as, well, the best possible valuation for the assets. And we just talk a little bit about some different ways we can value an asset. We can look at the book value of an asset. We can look at the market value of an asset. And then we can talk about mark to market. And the assets in investment companies the attempt is to mark the asset to market, not what you paid for it, but what is the current market value. And sometimes we would look at the most recent trade, and sometimes we might look at the current bid-ask spread, and we'll see why in a minute. Why it might not have traded for a while, the price has moved, and if the bid-ask spread is if the range of the bid-ask spread, if the last trade is outside the range of the bid-ask spread, that's the best way to say that. If the most recent trade is, say, $40 and the bid-ask spread is 42 at 44, well, then this most recent trade doesn't really, not really giving a good valuation. And so for sometimes lightly traded assets, we'll use the bid-ask spread midpoint as opposed to the most recent trade. Sometimes there are so many of these assets and they just never trade. We mark not to market, but we mark to model. And there's a company called Markit, M-A-R-K-I-T, and what they do is they were created as a consortium, by a consortium of banks to create an arm's length valuation entity that could value illiquid assets. So there are hundreds of thousands of individual mortgage-backed securities out there, and very few of them will trade in a day. So Markit will collect prices and other information from the dealers that do trade and create an estimated mark-to-model price for all of the other mortgage-backed securities that don't trade, for example. And so for securities that don't trade very often, instead of coming up with a mark-to-market or even a bid-ask spread, because there just may not be a good bid-ask spread for some of these things, a model price will be used, a mark-to-model. Let's just talk about the last price versus the bid-ask midpoint. And here's an example. What I have here is prices for call options on Walmart. And this screenshot was from 2/15 on October 8th. And the price of Walmart was $141.60 at the time. And note the time and the date of the last trade shown in the table. You can see that the time and date of the last trade shown in the table. So this was 2/15, and on October 8th, and you can see this first one hadn't traded in 2 days, this one hadn't traded in a few hours, same thing here, and this one hadn't traded in an hour, hour and a half. These are the strike prices, and so if the price of the stock is 141, then this is the right to buy for 141 when this price is 141.60. So these are in the money and these are out of the money. But the point is that you can see, for example, the $139 strike price call has a last price of $6.60, but the bid range is $635 to $655. And so the price of this option has decreased. And so if I use the last trade price, I will be overvaluing it. I should probably use the bid-ask midpoint, which would be $6.45 and not $6.60. And so let's think about the mark-to-market for stocks. Okay, that's easy. That I can do because they trade all the time, and I can look at the last price at the end of the day, and that's going to have been a recent trade. Penny stocks, they don't trade very often, and so I might have to go to the dealers and find what their last bid-ask values are, and then take a bid-ask midpoint because they may not have traded in a long time. Treasury bonds trade all the time, and so I can just look at the last trade. Right. Muni bonds, well, they don't trade very often. And so again, I might have to go to a dealer and find a quote and say, what's your bid-ask spread? Take the bid-ask spread midpoint. Mortgage-backed securities, there are so many of these individual bonds and they don't trade that I might have to do a mark-to-model, and there aren't enough really dealers who are making markets and all these things, so I might have to do a mark-to-model as opposed to a mark-to-market. And then options we saw with the bid-ask midpoint. Liabilities. Let's talk about liabilities quickly. Most investment companies will have no liabilities, and so mutual funds don't borrow money. They have no debt. And the only liabilities they might have would be some small unpaid expenses, as in payables, but most mutual funds have no debt or no short positions. And so we could really just take the value of the assets divided by the equity. That's going to be about the same as the value of the assets minus the liabilities. divided by the equity because they really don't have a lot of liabilities. We'll talk about hedge funds, which may carry liabilities later, but most mutual funds and other investment vehicles will have no liabilities. And now the equity. Equity is the shares or its limited partnership stakes. And let's take a minute and we'll talk about the different types of investment companies. We'll talk about some limited partnership investment vehicles, but the ownership stake for these funds is either going to be shares in a corporation, or they're going to be limited partnerships, which are equity stakes in partnership agreements.